Is the Singapore market hitting a record high? It might seem that way, but what if I told you that some of the biggest, most established blue-chip companies on the SGX are currently trading at a massive discount? Today, we're pulling back the curtain on 5 household names that our research shows are significantly undervalued. We're talking about industry giants in property, banking, and even travel. Stick around as we break down why these stocks might be the hidden gems in your portfolio. But first, a very important note. This video is for educational and informational purposes only and is not financial advice. Please consult a licensed financial advisor before making any investment decisions. First on our list and our top pick is Hong Kong Land Holdings. Hong Kong Land is a legendary property group, essentially the largest landlord in Hong Kong's central financial district. They own an incredible portfolio of interconnected, premium office and luxury retail buildings that are always in high demand. So why is this giant undervalued? The market is punishing the stock for its exposure to mainland China's struggling residential property market. For its 2024 financial year, the company reported a significant underlying profit decline to $410 million. But here's the secret. This was mostly due to non-cash write-downs. Their core rental business in Hong Kong remains incredibly resilient and profitable. Here's the most compelling number. Hong Kong Land is trading at a price-to-book ratio of just 0.47x. That means you can buy its shares for roughly half the actual value of its assets. This is a massive discount compared to its peers. Their new Vision 2035 strategy is the catalyst to unlock this value. They're selling off riskier assets and doubling down on their core, premium properties with the clear goal to double dividends by 2035. Management is so confident that they've expanded their share buyback program. Hong Kong Land is a classic value play. You get a world-class property portfolio at a 50% discount with a clear strategic plan to reward shareholders for years to come. Next up, we have Wilmar International. Wilmar is one of Asia's largest agribusiness groups. They do everything from cultivating palm oil to producing the cooking oil, rice, and flour in your kitchen. Their scale is immense, with over 500 manufacturing plants worldwide. Now, Wilmar's stock has been hit by volatile commodity prices and a specific legal case in Indonesia. This pushed its core net profit down in FY 2024. But this short-term noise is masking a brilliant strategic shift. Wilmar is aggressively expanding its downstream consumer products business. Think branded goods. This creates a much more stable, higher-margin business, much like a typical consumer goods company. The key metric here is its price-to-book ratio of just 0.70x. This means the market values the company at less than the value of its assets, ignoring the long-term potential of its growing consumer brands. Wilmar offers a chance to invest in a resilient, vertically integrated giant at a discount. Once the market looks past the temporary headwinds, its strategic pivot to consumer goods should unlock significant value. Our third pick is Capital Land Integrated Commercial Trust, or CICT. CICT is the largest real estate investment trust on the SGX and a proxy for Singapore's prime commercial real estate market. They own a massive portfolio of top-tier malls and offices. REITs are loved for their dividends, and CICT is a consistent performer. In the first half of 2025, its distribution per unit, or DPU, grew by a healthy 4%. Operationally, they are rock solid, with a portfolio occupancy of over 96% and rising rents. So where's the discount? The market has been focused on a temporary slight dip in revenue caused by the trust selling off one asset to reinvest in even better ones, like taking full control of the iconic Capita Springs skyscraper. CICT trades at a price-to-book ratio of 1.19x, which is just below its sector average. While this discount is more modest, the combination of its quality, strong operational performance, and clear growth from its strategic acquisitions makes it very attractive. CICT is a high-quality, stable REIT trading at a slight discount.
Its strategic upgrades are temporarily masking its strength, offering a solid entry point for long-term, dividend-focused investors. At number 4, we have one of Singapore's banking pillars, Overseas Chinese Banking Corporation, better known as OCBC. OCBC is the second largest bank in Southeast Asia, with a powerful presence in consumer banking, wealth management, and insurance. The entire banking sector is facing pressure on its profit margins as interest rates are expected to soften. OCBC is no exception, but the market seems to be penalizing it more than its peers. Let's look at the valuation. OCBC trades at a price-to-book ratio of 1.25x. Its main competitor, DBS, trades at a P/B of 2.11x. This is a huge valuation gap for two banks with similar top-tier credit ratings and market strength. OCBC has a rock-solid balance sheet and is strategically focused on capturing the immense wealth and trade flows between ASEAN and Greater China. They're also actively rewarding shareholders, announcing special dividends and share buybacks. OCBC is a fundamentally strong bank, trading at an unjustifiable discount to its main rival. It's well-positioned to navigate economic cycles, making this an excellent opportunity to buy quality at a reasonable price. Finally, our fifth pick is the world-renowned Singapore Airlines. Singapore Airlines is a global 5-star airline and a symbol of excellence. After the pandemic, it delivered 2 straight years of record profits, driven by the explosion in travel demand. This is where it gets interesting. The market expects those record profits to normalize as competition returns. Because of this, SIA is trading at a stunningly low price-to-earnings ratio of just 6.7x, far below the market average of around 14.6x. Analysts, however, are overwhelmingly positive, with 16 out of 17 recommending a buy. Why? They believe the market is overreacting. SIA has a best-in-class brand, a young, fuel-efficient fleet, and a fortress balance sheet. These are powerful advantages that will help it navigate industry headwinds far better than its competitors. Singapore Airlines is for investors who believe the market has overly punished the stock for an expected and natural return to normal profitability. Its low valuation offers significant upside if you believe in the long-term power of its premium brand. So to recap, here is our final ranking based on the margin of safety, growth potential, and risk-adjusted returns. Number 1, Hong Kong Land, for its incredible 50% discount to asset value and clear turnaround strategy. Number 2, Wilmar International, for its solid asset base and smart pivot to a more stable consumer business. Number 3, OCBC, offering a high-quality banking franchise at a significant discount to its closest peer. Number 4, CICT, a resilient and well-managed REIT with steady growth catalyst. And number 5, Singapore Airlines, a contrarian play on a world-class brand that the market may be underestimating. Each of these companies presents a compelling case for being undervalued, driven by different factors, from temporary headwinds to strategic shifts the market hasn't priced in yet. Which of these stocks do you find most interesting? Let us know in the comments below. And if you found this analysis helpful, don't forget to hit the like button and subscribe for more deep dives into the market's hidden opportunities. Thanks for watching, and we'll see you in the next video.